Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. It's December 8th. It's Thursday. The end of the year is quickly approaching. It's about 8:11 in the morning, and the market's going to gear up to open about an hour and 18 minutes to be as specific as I can with you. Now, the Dow is up about 100 points. The Nasdaq is up 45 points, and the S&P is meeting us in between. Now, here's what you need to know. The S&P has been down 5 sessions in a row, so it wouldn't be a big surprise that we rallied a little bit today. But again, the route right now is negative. It's not positive at all, and I'm not looking for any miracles or what did I say the other day? If you're expecting butterflies, fairies, and rainbows, this is not the market for you. Matter of fact, I wanted to show you something interesting. This is the Russell 2000. This is the number of stocks trading above the 50-day moving average. Now, we were looking at the S&P. This went up to 90th percentile. It's now at 78th percentile. And the number of stocks above the 200-day moving average is barely at 54 percentile, which means the market is becoming increasingly vulnerable again. And 1, 2, 3, 4 of the 11 sectors are now below the 50 threshold or at 50 threshold, which is not happiness. Also, the energy sector, we're seeing a lot of downside in the near term, but we're seeing the opposite. We're seeing some really good continuity and some good foundational strength at the 200-day moving average. If this number starts getting below 55, 60%, then I'll start getting really concerned. But right now, it's still very stable. And I'm not too concerned about the 50-day moving average because this is very short term. This actually tells me that it may be a good time to buy energies, as you will see right now, by how oversold we are. Not quite yet, but almost there. Take a look at it long term. See that? We're almost down there at the end, and it's almost time to go long energies again. So I wouldn't be throwing energies out with the bathwater. I don't think we're there right now. But you got to be careful. Look at the Russell 2000. 50% of stocks are trading above the 50-day moving average. And this was 95 last week on the Dow. So you got 50% here and 85 here. No. You can't have that kind of disformity between different sectors. It's too much. 39% are trading below the 200-day moving average or above the 200-day moving average. 52 on the Dow. Folks, if you don't see the cracks in the foundation, there's nothing I can do at this point to make you see them because I've been talking about them for a few weeks now. Volatility, as I said, is going up, and it's now above the 1128 area, so it's a 2-week high in volatility, and I'm expecting more and more and more upside. The bond market appears grossly overbought. I mean, I think it's trying to go to the 200-day moving average. We're short the bond market right now. We got in right around here, the top of this channel, and it went against us a little bit. But I believe that we're going to cool off and come right back down, and bonds are going to come down because I'm not seeing any deflationary pressure on the horizon. Now, the big report, which I'll circle back to in a minute today, is the jobless claims. So far, this number has not been instrumental at all. The 4-week moving average has been right around 225, 220, between 200 and 225. 228 is the estimate. The range is between 210, 254. Not really seeing anything crazy there. Tomorrow, however, oh boy, we've got the PPI report, and next week we've got the CPI report, and we've got consumer sentiment. Now, that may be a trigger for the market. Now, the PPI is going to be very interesting because the Fed has kind of put themselves in a corner right now. It's one of those situations where if the report is negative, that means what they're doing is not working, right? And if what they're doing is not working, they need to keep raising rates. Now, if the report shows that the number's better than expected, that means the economy is moving faster than they expected, and that's not good either. So to me, it's almost best if this report came out almost exactly as expected, because 0.75 is still not baked into the market as a high probability. 0.50 is, which isn't all that great either. But again, that's what I wanted to bring up. Now, let's talk a little bit about global economy and see what happened last night in Europe and how it's going to impact the U.S. stocks here. Before I begin, I've been doing this every morning. People have been really liking, and if you're enjoying this, or if there's a segment here that you really like and you want me to cover more, let me know. Post it in the video, in the chat below the video in the YouTube Wealth Press channel, and I'll gladly talk about it. So, I just missed one right here. So we got Costco today. That's huge. That is huge, 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 huge. And I want to know how Costco is anticipating the next couple of quarters. This is a very important company to report. AVGO, Broadcom is reporting today. British American Tobacco, this will be very interesting. Lululemon, one of our publishers' favorite companies. I love this company. I wear their clothing all the time. I don't know if you guys know this, but they make clothing for men too. Really good jackets, like light jackets, athletic clothes, good stuff. Chewy, where people buy subscription pet products from, not been doing all that great with the reopening, with people have been going to pet stores. Like we stopped ordering from Chewy. We've been going to the store next door. DocuSign, Sienna. So there's a couple of interesting stocks. Some are big, like Costco and Broadcom and British American Tobacco, BTI. Some are not so big. But it's interesting because Costco is a very instrumental stock. It's kind of like Target. It can really impact the whole consumer staples and the consumer discretionary sector and the bond market, which we need to keep an eye on because I think we're going to start turning lower because I'm not seeing any major catalysts causing the market to go higher at this time. So market participants weighted growing prospects of a recession associated with the pace of the Federal Reserve monetary policy tightening, which is why the market went down today, according to this report. There's always an excuse. There's always a story behind it. NASDAQ slid for the fourth time in a row, weighted by Apple and Tesla. S&P 500 dropped fifth straight session in a row. Folks, this is not a crazy bull market, not even close. Data on Wednesday showed that third quarter productivity rebounded at a slightly faster than expected pace, but the trend remained weak, pointing to elevated labor costs and high inflation. And now, these are the odds. I show you this every morning. Now we have almost 80% chance of a 50-point base hike and 20 of a 75. If the market keeps coming lower, if the PPI is weak, this number may actually go to 30. I'm being a little, well, I don't want to say optimistic. I'm being really pessimistic. But nothing is off the table. Today we have the jobless claims. As I mentioned to you, this is not a really big number because it's been coming along with expectations. The jobless numbers have been solid. Investors are going to be looking at continuing claims, which were at 1,600 last week. They're going to be down to 1,600, 1,608, 1,600. Not really 1,600,000. Sorry. Not 1,600, 1,608,000 versus 1,600,000. I got to be specific with you. Euro. In Euro, we're down just a little bit. Investors are worrying about the state of global economy ahead of next week policy setting meetings, and we've got two of them. European investors are waiting key meetings by the U.S. Federal Reserve and the European Central Bank next week, which I think happens 12th and 13th. And these two central banks are widely expected to continue their rate hike to cool off inflation, which is why I'm not seeing a major catalyst to help us bring this market higher right now. Shanghai's composite today closed slightly lower, giving the country still grappling with record high daily increase in COVID cases. However, the report on further relaxation of anti-COVID curbs in Hong Kong helped limit losses. China on Wednesday announced further easing of movement curbs and testing mandates in most cities, indicating that Beijing may plan to scale its severe COVID policy. It's nasty. At the same time, the Nikkei closed lower after data revealed that the country logged an unexpected current account deficit in the third quarter. The GDP showed the Japanese economy contracted slightly less than anticipated. Let's look at price action. In terms of sectors, remember I told you that healthcare and industrial are going to really be good? Well, guess what? And consumer staples, they're back. Remember, consumer staples fell all the way down here, just like utilities are, and I said they're going to come back up, and they did. Basic materials, financial, energy. Folks, don't write energy out just yet. It's fallen before. Energy, while we have inflationary environment, and while the war is on the table, OPEC is going to do, and energy companies are going to do everything possible to squeeze every last dollar out of you. So please, 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 don't think that it's over. Looking at this technically, just to give you a little roundabout, healthcare looks great. Industrial looks like it can drop a little bit more here. Consumer staples, I like healthcare and consumer staples a lot right now. Basic materials is exactly looking like industrial. Notice they almost look identical. I wish I could move this over here, but look at this chart and look at this chart. I mean, it's like we're looking at the exact same chart. It peaked out, let's see, September 12th. This peaked out September 9th. I mean, it's like looking at the same thing. There's probably a link trade here between XLI and basic materials. That's Jeff's department. Financials look like we can cool off a little more. Energy looks like we can cool off a little more and actually come down to the 82, 83 level. Technology looks like it's going to break down hard. Utilities, I think, are going to continue trending quite a while. Communication sector is going to break down all the way down, in my opinion. Real estate, I think, is going to stay kind of where it is right now, kind of keep doing what it's doing, maybe follow utilities. Utilities and real estate look like they're exactly in the same boat right now. Consumer discretionary, communication services, and technology look like they're in the same boat right now. Energy and financials and industrial and basic materials look like they're in the same boat right now. Healthcare and consumer staples looks like it's got more upside to go. So you got to be really, really, really cautious. Now, because today's Thursday, what do? I give you my top ETF, and I give you an option with it. So I'm going to go back to consumer staples, ticker symbol XLP. If you've been listening to me for the last several months, then you would have been doing really well with consumer staples. They've bounced back really hard. They're above this level right now. I think they're going to move higher. So let me give you an option price. And we'll go out all the way to February. And it's got 70. We're at 76 right now. You can easily go 75. Look at this. There's not even a lot. And I wouldn't do it now because they're illiquid, so you see the big spreads. But if you go later in the day, the spreads in these will be very tight towards the end of the day. But I would stick with the 75 through the 77 range because they're not expensive. And you're getting pretty good value, and you're going in or right at the money, or 75 would put you in the money. But the point is, I like these right now, and I think we're going to see some more upside in defensive sectors. Now, if you're looking at individual stocks, I want to show you guys something interesting. There's only 67 stocks breaking out to 20-day highs and 120 breaking down to 20-day lows. Now, I believe the market's going to come down. This 120 level, that's nothing. That's 1/5. 1/4 to 1/5 of the power we can produce to the downside. So far, we're still in choppy land, even though the market went down 5 days. That's how overbought we were. Remember I said we're throwing peanuts at the elephant? The elephant is turning around. We're getting its attention. Well, we finally got the elephant's attention, and he's now slowly moving towards us. Just kind of like, what? What do you want from me? Why are you throwing this at me? He hasn't gotten really angry yet. He's about to. So I think that's coming up, and you could see with volatility, that volatility is starting to rise. Be very, very, very careful. We've got some really interesting data next week, and I'll keep you guys prepared every step of the way. But you want to be really defensive right now, and you want to be very, very disciplined in your approach. Healthcare, consumer staples, wait a little bit more with energy. The time will come, but be very, very patient. Stay away from discretionary sectors. Now, my friend Chuck Hughes, he's been working on a project bigger than anything he's done in his nearly 40-year career. This cat's been at it for 38 plus years. I've been doing it 29 years next month. He's got me beat by 9 years. It's an indicator that allows traders to get ahead of potential massive buy and sell orders in real time. The goal is to get into trades before big money can send a stock moving in one direction or another, and it doesn't discriminate. It takes long trades and short trades. It trades just to the downside like it trades to the upside. It's actually really, really cool. The goal is to get into the trade before big money can send the stock moving in one direction or another. Now, this indicator, it's an indicator. It generated 8,141 historic back trade setups going back to 2002. So this thing has been generated, and it's got a win rate going back 20 years of over 75%, and going back 10 years, 78%. And Chuck's in love with this thing. To learn everything about this indicator, plus which stocks it's signaling right now, make sure to click the link below. Don't delay. Don't procrastinate. Chuck wants you to hear about his champion indicator. Now, make sure to learn everything about this indicator. Follow the link below. Learn which stocks it's been hitting on. Learn how to use it to get best results with it. Now, if you've been struggling to hit your trading goals, or you want an edge in the market, I think you'll get the details, and I think you'll be very, very happy with this, because he'll show you how to use this indicator. He'll give you several examples, and you can incorporate this into any analysis you want as a validation tool. I'm doing it, Chuck is doing it, our publisher's doing it, and you should do it too. follow the link below. And if you're on our YouTube channel, follow the link in the YouTube Wealth Press channel. You need to check this out right now. You really do. And post comments, feedbacks, and nice and bad or whatever questions you have in the YouTube channel, and I'll respond. And if you have a question, post it there, because if you have a question, others do too. YouTube Wealth Press channel. All these videos get posted there at 8:30 in the morning. And you can subscribe to our Telegram channel, and I'll send you heads up with a picture of my pets. I have 8 of them. A lot of pets. That's why I work so hard. I got to feed 8 pets from Chewies. Follow the link below. Check out what Chuck's got in store for you today. I had dinner with Chuck last night. He is so excited about this. He is in 7th heaven, and you will be too after you get your hands on the champion indicator. Follow the link below. What else is there to say? Bye, guys.